All right, so today started off on a really good note. Really big move, very predictable considering kind of what's been driving the market over the past few weeks and what started driving the market today. But what's interesting in the move and what kind of made it unique today versus what we've seen over the past few weeks is how it traded throughout the day, throughout the rest of the day. So we're going to break down kind of what that move was. We're going to also identify some patterns that are developing, some kind of cracks in the facade, so to speak, that are kind of developing. We're going to talk about how significant those gaps are, whether they're significant at all, and what implications that they have for us in terms of like, are we going to be able to hit? I think that the goal is to get to 4,800 by the end of the year. I think a lot of talking heads are kind of talking about getting to at least 4,600, if not four. We almost got there today, but potentially up to 4,800. Kind of keep this train going. This explosive move that we've had. And we'll take a look at a stock for our trade idea today. It's had its own explosive move. So we'll talk about how to trade that, considering the move it's made through today especially. And then, of course, our Black Friday sale, our Cyber Week sale is still going on using our Black Friday discount code on our website. You'll see that at the top of our website in that notification bar. You can be able to take advantage of that. It's a 20% off discount of our normal premium service, which when you compare it to our monthly service, ends up being about a 40% discount for the premium service on average per month to what you'll be paying per month for not even our premium, for our plus service, which does not have all the premium features to it. So it's a pretty decent discount. It runs through the rest of this week. So if you're interested, this is the time of year to take advantage of that before the week ends. With that being said, let's go ahead and get started. Today is Wednesday, November the 29th, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right, as well as up here. Again, I remember I talked about the Black Friday sale. There's the link to be able to join with this coupon code. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing with this thumbs up icon. Click that tab. Hit that like button there. Again, the more you do, the more you click those likes, it helps us get our content out to all of our followers on Twitter and Facebook. Again, I've been kind of stuck in the 70s. Let's see if we can. Our goal is to get to 100 every day. So we thank you to those who do like these day in and day out. Those who don't, you can do it right now while you're watching with one or two really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. As you see, the intermediate lines remained at very, very high levels, not only in the upper reversal zone, but above the 90th percentile. So as you can see, it doesn't stay above the 90th percentile for very long when it does. And we've been above 90 now for pretty much starting ironically on a down day, but 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14 days now that it's been above the 90th percentile. It's a very high level. Again, it can stay above the 80th percentile for a very long time. Rare to stay at extreme highs, which is, again, 90th or above. The extreme on the downside is the 5th percentile or below. The near-term line, of course, dipped into bearish territory, this is a near-term decline that we're on right now. The near-term is in, but this is barely there, and we'll see how long it stays there. We are still pretty strongly above the moving average at 4%, and a relatively bearish candle, though not, a little bit above average, right? It's one of the bigger ranges that we've had in a while. Yesterday's range was 27 points, and then 14, 7, of course, that's Thanksgiving, and then 23, and then 16. So it's been really, really small ranges until today. So a little bit bigger than average. The average has really come down. That's a very low number you'll see here in a second. Well above the moving average. So that's the S&P, of course, mainly driven by what's in the NASDAQ 100. It almost looks picture perfect here, like the same. So very, very high level there. For the NASDAQ. On the other hand, the Russell 2000 not as exactly the same. Second time we've had a long upper shadow in this area for the Russell 2000. Unable to quite get above that 50th percentile retracement level of the decline on the rally back up. So we are 4% above the moving average, but you can see, again, it's a higher beta. That's not that big of a difference relative to what we see on the other indexes. And the intermediate line's not as extremely high either. And you can see the near-term line barely peaked with a pretty bearish peak because it didn't get in the reversal zone. Barely got in the reversal zone there. Didn't get in the reversal zone here. And didn't stay bullish for very long. So it's starting to show some cracks, some signs of weakness there in the Russell 2000. Again, especially with that long upper shadow. Let's take a look at the long-term chart. We take a look at the long-term chart here, and you can see we got a higher high. We have a higher close as of now, but we still have 2 more days left. But as of now, it's a good bullish candle. But what stands out is the fact that the size of the candle has dropped below its moving average, and that's a sign of weakness here. Usually, when you get that, you're either already getting a transition candle like we did here, or you're about to get one, like say next week. So that means you might not get you'll probably get a lower close, and a upper and a lower shadow. So that's something to kind of watch for as. Again, depending upon how we finish this week, it's something to watch for going into next week. Remember, the Russell 2000 is actually still below the Hakinyashi close. Is still below its 40-week exponential moving average. So we're still in this bearish level, and it also has a bearish crossover on its chart. So again, setting up for some weakness here. Again, depending upon how we close this week, we're setting up for some weakness starting next week. We got red arrows on the MACD, on the S&P and the there we go, S&P and the NASDAQ. We do not have a red arrow yet on the MACD, on the Russell or the Dow, but you see how close they are, and then we'll see what the stochastics is. We're nowhere near a red arrow on the moving average, but as I showed you in a previous video, it won't take long, right? If we start to be bearish, you can get that third. Once you get the first red arrow, it usually takes, if we end up with 3 red arrows, right? Because we might not. We might just stay kind of sideways. But if we do end up with 3 red arrows, it usually take, even at it, as I showed you in previous examples, when we were further away from the moving average than we are now, it still only took like 5 days, 4 or 5 days to get that third red arrow. So that, again, puts next week into play for, again, if we get 3 red arrows, when we might get it. Again, based off the timing of when we get the first red arrow there. So that's something to keep an eye on. You notice if you look at when you break these moving averages apart, you can see you're still easily above the 8 days. So, as bearish as we are with that MACD finally crossing below its moving average, and that's where the red arrow comes. Stochastics is also below its moving average, but again, both well in the reversal zone. So as weekly bearish as that looks, you're still easily above the 8-day moving average. You're still above the 78% retracement, like we were back here in July, of the correction, right, of the whole correction. And then, of course, you are back up above the 78% retracement of this decline that we've been on. So you made our way up above that too. And then, of course, easily above the 23% retracement once we had that the CPI report, right? Once we broke out there on the CPI report, we got above the 23% retracement of this line. So very, very good move that we're still at very strongly bullish levels, even if we haven't crossed above the 100 level, the 100% marks on either of these, which would obviously mean new highs. Either new highs this year, 52-week highs, or new highs at 4,800 would mean all-time highs, right? Getting back to its all-time highs, which again, it's been 2 years since we've had an all-time high. That's a long time for a correction that we had in 2022 that we haven't rectified yet. Let's look at IWM. And you can see, again, that long upper shadow failing at the 200-day moving average for a second time. Still above the 8-day. You don't have the red arrow yet. Stochastics isn't as bullish, right, because you're below the 80th percentile. But you can see you're still above the 8-day moving average. And again, failing at the 200-day is a little bit more significant for Russell than what you're seeing on the S&P, as you filled in the gap, essentially, between the 50 and the 200 and haven't changed. If you look at where we are relative to the weekly candle, you can see, we're still below the 30 and 50 week moving averages here. So after a big, couple really big weeks, we've had a couple really small weeks coming after that. Let's take a look at some of the other oscillators. The DMI for the S&P, strongly bullish. I mean, again, that's, low level, below 15. Hasn't dropped below 10 yet, but you are below 15. The ADX is at 34. Again, but it was a lot higher over here in July, but still very strong move in a very short amount of time. Again, short amount of time. If I were to break this in half to look at kind of the short-term DMI, the ADX is higher than it was over there. So again, this was a longer move to get to a very elevated level. This has been a much shorter move, and you can see the negative has been below 10 for a long time. And like I said, the ADX is at 64. That's, let me give you some context on just how high that is for a short-term move, right? So this, if you look out, we were there's 2 times that we've been higher. Like there's been one time we've been as high, kind of in this level there in November, right before this correction started. It's about when it started on the Russell. And then you had a higher level here in September 2020. Again, VIX was a lot higher then. So it led us to these kind of moves. And that was a parabolic move that you can see we kind of retraced pretty sharply. And then, we had a downside. COVID was equally, the DMI got as equally bearish there. So, I mean, again, we're kind of looking at a move kind of like the COVID drop is the kind of move we're getting right now. That kind of puts this move in the context a little bit about how severe it is. Here's another time where we were close to here on a bullish move, and again, right before correction started. So are we right before correction starts? Again, that's, this is the biggest cluster of arrows that we've seen since August. And we've had other clusters of arrows back here going into that parabolic peak. And then a little bit here in 2019 as well, going into that correction. So needless to say, an extreme short-term move. And as, Walter Deemer says, and actually I think he's quoting somebody else, parabolic moves don't end sideways. They don't, they take longer than you expect. They cause the most pain, right? And then they don't usually consolidate sideways. And that's kind of what you see here. You look at the RSI and the CCI, again, we're below 70 now. So we were above 70 all day today. We're below 70 on the RSI, and you can see that the CCI is below positive 100, never did get above 150 on this move that started this weekly, see that weekly intermediate run-up higher. You can see we are prone for it to be a short-term move to the upside. As we saw in August, are we set up for another short-term move like that? That's a high probability. It's becoming more of a higher probability. Looking at the Ichimoku cloud, you still got a mature trend going. So that when you have a mature trend going, you're not looking for it to break the blue line. You're looking for it to break the green line at this time for signs of weakness there. So you can see you can be above 80 for a long time once you're in this mature level. So you look for it to break it, and once it gets back above, you're okay until it breaks it again, and that's when you start looking for weakness. We'll see, and we're getting closer to the green level, so we can stay in this area by the time we get to the green level here in a few weeks, and that would be a very positive development. IWM is not so positive, right? We failed, as of right now, we failed at the top of the cloud. We just barely got the crossover. And we don't have a mature. We have a barely an intermediate trend strength going. So much different scenario there. Looking at the Bollinger Bands, again, we haven't been in the upper quartile for this whole time, despite the fact that we had such a big move to the upside. We never really did get even above the 90th percentile. So that's kind of an odd move. But part of it's because of how big the bandwidth already was on the bearish move, right? You can see we kind of flip-flopped. You can see we flipped from bearish to bullish without red dots. We were green the whole time, so it was already volatile. That's why we haven't had we can push higher on the bandwidth to a much higher level without getting outside the bands. But it does kind of tell you, it's a little bit of a weakness, and we're still above the Keltner channels, and that would be the next sign of weakness, is getting below that upper Keltner channel. As you see the momentum, as high as it is, starting to falter there. Looking at today, we gapped up to the upside today and got a new high on that opening gap. We filled in the gap by the end of the day. You can see last week's range as tight as it was there. Here's this week's range so far. Again, still pretty tight as well. We did get another touch at 100, which puts any kind of bearish breakout move 6 days away. It takes 6 days for the green line to get below 70, which is kind of what you'd look for before the red line spikes to 100. 6 days from now, 1, 2, 3, 4, 5, 6. The low point for the 4-week range is going to be right there. So if we were to, look at it. Like we moved up so far, we move up fast, then we go sideways. So we move up fast, and we go sideways. It opens up there's not very much support here at all on an intraday basis. So we can come down and flirt with that low point in a matter of days very easily, right? There's nothing that's holding us. So there's no strong level of support that's holding us up here. And in fact, it's kind of more of like a high wire act right now when you consider there's hardly any volume below. There is a little bit at that last week's low. So it had to break last week's low and then, again, fill in that post-CPI gap. And we'll see if that ends up happening or not. Looking at I told you today's range picked up. It's one of our bigger ranges that we've had in a while. Sorry, wrong chart. The range picked up here, so it ended up being a little bit above average, 4.12 points. The volume is still below average at 63 million. So if I come down to these numbers, look how we're easily below 1%. The ATR is down below 4 now. Very, very low levels. The volume's already back down to close to the 52-week lows for this 20-day average volume. So again, it shows just how fast things have changed. And when it goes this fast, it's kind of hard to sustain such a fast move like that. And here's the other thing that stands out about, why we might see some volatility sooner rather than later. Look at the correlation between the VIX and the VVIX. The VVIX has been actually rallying here over the past couple of weeks. The VIX has not been, obviously. It's below 13, ended up just a smidgen below 13. And the correlation is negative, almost 25% correlation to the negative correlation. Usually when we get these negative correlations, they usually get resolved with a move back in the direction of the VVIX, which in this case it's the VVIX that's negatively correlated because it's rising, which means that we have to fill in that gap there with the VIX and suggest that we might be more bullish on volatility here in the short term. As low as it is, being below 13, and that sparked the last rally in volatility. We'll see if that ends up sparking this rally in volatility as well. All right, now let's take a look at what's driving this price action here. And this is an interesting pattern that you see. Look at gold now up the similar amount over the past 3 months as the Qs. Actually, it's kind of outpacing the Qs barely, just barely though. And that's not necessarily with a weak dollar. Now, the dollar's been weaker over the past couple of weeks, but the dollar's actually been up over the past 3 months. That's why IWM, as bullish as it's been, is actually still down 3.5%. And yields are also bonds, while bonds have been rallying, are also still down almost 3%. So it's been an interesting pattern. Let's take a look at just what happened here today. So let me zoom out here. To the 29th. And you can see emerging markets had a bad day today. Bonds had a really, really good day today. What's interesting is the yields were down. And generally speaking, when bonds are up that much, look how strong, when it was up early in the day, IWM just was up it was up over 2% at the very beginning of the day. Just killing it. And the Qs were up 1%. Nearly 1%, very, very strong. By the end of the day, bonds stayed. In fact, bonds were higher at the end of the day than they were at the beginning. The IWM lost more than half of its gains, as it only finished with a 0.5% gain. The Qs actually finished with a loss, despite starting the day off 1%. And then the dollar, you can see, was flat the whole time, putting pressure on EEM. So, again, it's kind of interesting to see because that's been the driver, right? That's been the big driver of this action here, is this drop in yields. That's been a driver of a lot of the bullishness, and it's a big drop here. Now, granted, we've already had a good move. We've already had the peak in the MACD histogram, so that means we're going to be hitting the bottom soon here, because that's what happens. You get a peak in the histogram, you get the bottom in the MACD, and that turns up, especially at these lower levels like this. So the bottom in the histogram is coming soon, because we've already bottomed on the MACD, excuse me, because we've already bottomed on the histogram. So, again, how much we haven't dropped 50% below the 50%, just like we haven't dropped below the 50% on, let's see, I think on the commodities on the dollar, we've dropped to that 62% retracement. And so far, again, histogram's already formed as low. The MACD is pretty low in the 20th percentile. That's going to change dramatically when over the next week or two when these come off. This week or two over here comes off, and we get a new week or two over on this side. So it's gonna, that number is gonna start dropping even if we go flat on the MACD, because we're gonna start losing the lower figures that you see below, the lowest figures of the year. But the fact that we are kind of so far holding support kind of is a little telling. And then finally with the commodity index, you can see again they're sitting right at that 200-day moving average. And now in 2 days have bounced back above the 17-day moving average, with the MACD and stochastics rising. In fact, if you look at crude oil, it has not broken above its 17-day moving average yet. It's like right there on it though, and the MACD and stochastics rising. You can see the point of control, and again we're back to the 62 after hitting the 78% retracement. We're back to the 62 and working our way higher. So you wonder if that's what the market kind of saw today, is probably not buying that drop and looking at that drop as more of a fake out. And when the market stops rallying on the news or the catalyst that was causing it to rally initially, that's a little bit of a sign of exhaustion, at least in this case, of the broader market and the kind of move it's getting. You're seeing a little bit of exhaustion in the breadth as well. When you look at like the McClellan oscillator, it's still above 35, so it's still relatively strong, and the summation index is well above zero, not quite above 500 yet, but well above zero there, easily above zero. But if you look at other signs of breadth that we look at, which would be like the number of new highs and new lows, never did get above 100. So we went negative yesterday. We're back up to 99 today. We're not above 100. We can't get going above 100 there. Then you look at the number of stocks above the 50-day moving average, and we're not pushing, and we're at a pretty decent level now, 380. I mean, 400 is 90%, and 80%, and 350 would be the 70%. So we're kind of in the middle, right, between 70 and 80% there, and with a rapidly increasing. And then you look at like the number of stocks above their 200-day moving average, and we're at that almost 60% mark, and wondering if we're going to peak again like we did last March with that. And one of the things we talked about today, another similarity to what we're seeing now versus last March, and I've shared this with you before, but we're kind of running on the end of it now, is, again, the two instances of being above 9% on the candles here, like we did back in March. We're doing it now. We've had a green hole now for 20 days. You're about to cross over the moving average there on the 200-day hole, on the gap of the 200-day hole. And we've had 6 days in a row now we've been below the hole, kind of in between the hole and the parabolic SAR. As you can see, the more you have days like that, the more likely you are for the reversal. So again, whether it's probably not going to be by the beginning of this week, but as you saw with all the other technical signs that we saw here and some of the other oscillators, next week is shaping up to be a volatile time. Again, whether or not we actually do drop, or that will depend upon a catalyst. We need a catalyst, something to come out and say whether it's yields bouncing back up for whatever the reason. But there's going to be something that kind of a spark. But we don't know if we'll ever get that spark. But we do know is the conditions are there for a significant move in volatility and a retracement in this market over the next couple of weeks. It's kind of like there's a lot of dry tinder. All it needs is whatever the catalyst to be able to spark the potential energy, which is built up to a large degree with all these signs I've shown you. There's a lot of potential energy for weakness and volatility. And again, I'm not talking about like we're not going to tank, but retracement weakness at the very least, more than just like 2% retracement. But retracement weakness in the markets, there's a lot of potential energy there that once there is a spark, whatever that is, no one knows what it is, otherwise they'd already be pricing it in. So whatever it ends up being that nobody knows, then that will convert the potential energy that's really built up into an active move, right? An active consolidation, active energy, an active consolidative move. And then of course, then it'll just be a matter of how much consolidation. As you saw last March, we just ended up going down to new lows. As big as the move was off of that, we just ended up, because again, you look at the zigzag chart, we think that this move, and if you watch financial media, you would think that this move is like singular move that we've never seen before. But we've seen a move just like this last year in March, right? We dropped 13% off the highs on what looked like it was a pretty deep correction. It was kind of barely starting a correction. We rallied 11%, and a lot of people thought it was over, and then we went to new lows. There's no way, and there weren't very many people in March, at the very end of March, thinking that we'd be down at 36.80 by middle of June. And it's the same thing, like right now, can we get to the banking crisis lows of earlier this year, which would be about 38.50? Can we get to those levels? I mean, there's not a lot of people right now that are thinking that, because everybody, like they were then, were thinking. I mean, Tom Lee's call back here was that we'd get to 5,100 by the end of the year, and obviously we didn't do that. He eventually changed his call to 4,800 during this period, all the way up to here. He had it at 4,800, and we didn't get to that. And so the call right now again is 4,800 by the end of this year still. So there's not a lot of people thinking that, but it's the same thing. Like, we rallied 10.75. We haven't even rallied as much as we did last March, coming off of a low that was slightly lower than what we saw last March. So it kind of gives you an idea that this is hardly a unique move. It's hardly a unique move at all. And again, barring whatever the catalyst it is that sparks whatever kind of retracement, we might not get. We might just get a normal 38% retracement, bounce off a higher low, move up to higher highs. We wouldn't hit 4,800 by the end of the year in that scenario, but we'd hit it eventually at the beginning of next year. And that would seem to be more likely, right, than hitting it by the end of this year. So that's a possibility. I think it's a lower odds of that. I think the higher odds are eventually moving down towards these lows, as I do believe that we are in a correction phase right now in the market. Barring this, just like I thought we were in a correction phase over here, over here, even with that 11% rally. And I thought we were still in the correction phase over here, even with that 17% rally in August, because, as we talked about then, the red flags that were showing up that were suggesting these moves were like I said before about this one, these moves were puta booyah moves. And I would think that this one is too, based off a lot of the very similar red flags that we're seeing now that we saw back then as well. Let's take a look at how the sectors perform. So let me pull up the sector comparison chart. And you can see, of course, your two big XLK, XLC, the big market cap stocks and everything else. But let's just look at today. So bear with me one second while I pull up November 29th. And you can see today, again, off the very start, right? We were up. XLK was up. XLY was up. Real estate was up. Financials and materials ended up doing well. Industrials. By the end of the day, XLC ended up down almost 0.75%, along with staples and energy and utilities, interestingly enough. And then you notice technology, again, was up over 1% at the beginning of the day. Discretionary was up over 1% at the beginning of the day. They end up either negative or slightly positive. So a big reversal. And again, kind of a sign that maybe we're not when you see a reversal like that on a day where you would have fully expected. And like this day, when you see financials up and utilities down, that's the day you think that yields were higher, not lower. And when you see everything falling like this, you would think that yields moved higher throughout the day, not lower. If I look at the intraday here and see exactly what kind of move yields had throughout the day, and you can see they did go higher a little bit, but they ended up near the lows of the day. So not the kind of move, and it makes you wonder if the market is already starting to price in a higher move in yields with what we're seeing. What we're seeing with that sector rotation today. All right, now let's take a look at our trade idea of the day, and I want to take a look at Las Vegas Sands. Las Vegas Sands had been a little weak here, getting a bull tag yesterday, but then today, really breaking down hard. The near-term line down, the momentum line hit extreme lows on the bull tag. The near-term line got down into the reversal zone, deep into the reversal zone. We are now over 5% below the moving average. The intermediate line is crossed below, slightly below the 60th percentile. So it's out of bullish territory. That's a pretty significant move for the stock. If you take a look at like its weekly chart here, you can see it's already got a bearish candle with a red arrow. So you're still in a death cross environment. We're trying to get back, and then we just failed getting up there and going to the upside. Looking at the 3 green arrow chart, you can see we dropped below. Remember, we got the bull tag yesterday. Today we dropped way below it and below the 50-day. MACD is in negative territory, so Stochastic's dropping down. Lots of volume on the move here today. When you look at some of the other oscillators, the DMI is showing a breakout pattern well above 30, below 20 on the positive with a low ADX that's just starting there. Looking at the RSI and the CCI, you can see what's happened here. You can see breaking below 40 on the RSI, well below 200 even on the CCI, with the breaking back below 0 on the weekly CCI. So big breakdown in that perspective. Looking at the Ichimoku cloud, we got up to the cloud, in the cloud. We broke back down out of the cloud, well below the blue line. Negative rate of change, no trend now. We hit 0 on the trend indicator, so big move down, big change in direction for the stock. Looking at the Bollinger Bands, you can see we broke below both the lower band and the lower Keltner channel today. So lower band and the lower Keltner channel with red dots, right? So we don't even have green dots yet with any kind of bearish momentum move that we may get. So it's a pretty bearish pattern. So what we decided to do was to do a bearish trade on it, of course. So we came down and we bought the 44, sold the 42. This is what it looks like on this chart with a regular position size. Let me get rid of that trade. We did this in the Market Outlook Live, right? There's our normal position size for a directional trade, which is half of our normal position size for a non-directional trade. And then you have your about a 3-to-1 reward to risk ratio, a little less than 3-to-1 reward to risk ratio. So really like the setup there for our trade idea of the day. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video. Use that Black Friday code for our Black Friday discount to sign up for our premium service. Follow and like us on Twitter and Facebook as well. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.